Okay, it's 4 o'clock and welcome everybody. Monetary policy update, Easter 2011. We'll give you our view on what's going on in the Swedish economy and how you translate that into Swedish monetary policy. Our conclusion this time is, as far as we can judge, the Swedish economy remains strong. And against this backdrop, there was a need to increase the policy rate by 0.25 percentage point. That's what we decided yesterday. And as far as we can judge for the foreseeable future, the policy rate, according to the interest rate path, will continue to go up. And this is very much so because basically the Swedish economy is doing quite well. Growth is high. It's unusually high. It will stay that way for another few years. Aggregate demand broadly is also good because exports will stay on the high level. Investments have picked up, and also domestic demand measured in various ways is looking quite good. So eventually, this means that inflationary pressures will increase, and that, of course, then means that there is a need for us to increase the policy rate. And as you can see here, looking at the growth numbers, these are quarterly numbers. That's why they sort of swing a bit more than others. You can see here that growth has been, and you know that, exceptionally high, and it's coming down, but it's coming down not immediately, and then over the years we'll sort of move towards some kind of a long run average when it comes to what is going on here in the Swedish economy. And also then if you look at this, you can see here, as I said earlier, that with exports increasing around 10% and then going down a bit, that of course means that we have favorable demand conditions, and then that eventually translates into increases in investments as well. They're lagging a bit behind. And then add to that consumption, as far as we can judge, is going to be fairly stable for the foreseeable future. This means that demand conditions are very favorable over the projection period that we have in mind here, and this all in all produces good growth for the Swedish economy. Now, as a consequence of this, labor market situation is also improving, and here, according to our projection, we expect unemployment to bottom out at a little bit higher than 6% in a few years. But having said that, it's also, I think, important to be mindful of the fact that behind this also is an increased supply of labor. So basically, when labor participation goes up, this is not the full picture, and despite that, still unemployment keeps falling. So all in all, the labor market situation is quite will be quite favorable over the years to come. And if you look at what's going on in the rest of the world, despite the discussions going on in various parts of the world about this uncertainty or that uncertainty, and I'll get back to that, global growth will stay at 4% plus something. And in some parts of the world, the BRIC countries, for example, are talking about much higher growth rates than that. And also in other parts of Asia, growth is high. And also what happens there is that inflation is picking up. Then on the other side, you see here Europe, which isn't all that bad because we're getting close to 2% for the euro area. And then we have growth in the U.S. at around 3%. This is not saying that there is nothing to talk about and nothing to discuss when it comes to various types of vulnerabilities. But all in all, looking at the world as a whole, growth will stay favorable over the coming years. Also, what is kind of underneath or behind this picture is given this variety and this spread between different growth rates, this will also, or is likely over time, to produce different types of monetary policy in various parts of the world. And we are not the only central bank that has started raising the policy rate, and this is also sort of one picture that we need to be mindful of when it comes to going forward. We have many uncertainties, as always, at this particular juncture in the report. We're talking about the natural disaster in Japan, which is, of course, a terrible event. We have revised down the growth numbers for Japan this year, but on the other hand, once reconstruction gets going, that will push up the growth numbers for years to come. The fiscal problems in the euro area are well known. They sort of jump from one country to another. The fiscal problems in the euro area are likely to stay with us for quite a while, because these types of issues you don't fix overnight. But on the other hand, when it comes to these fiscal issues, and if we're looking at the euro area as a whole, we should remind ourselves that growth in Germany is pretty good, and in the dominant economies in the euro area, things don't look too bad. And that is, of course, something which affects us, because we have much more trade, let's say, with Germany than what we have with Greece. So despite the daily debate in the newspapers about IMF programs and other things going on and how to solve their difficult situations, it's not a factor which is of major importance to the Swedish economy, and that holds both in relation to trade, but it also holds in terms of the exposure of our financial sector to those parts of Europe. And finally, we have the political unease in North Africa and in the Middle East, and what that might do to the oil price. And that's, of course, an issue that worries many. And the more the oil price goes up, then, of course, that will have an effect on global growth, and eventually also maybe in one form or the other an effect on global inflation. The issue here is not only one of energy prices. The issue is also commodity prices generally, and we have taken the stance that higher commodity prices are with us to stay, because basically global demand for resources will be such, as far as we can judge, that this is not something which is temporary. Then, of course, looking at just looking at the oil price, it's incredibly hard to actually do oil price projections. So basically, our assumption here is that the oil price will stay on the high side, and roughly where we are now. Then, if you translate this into Swedish inflation numbers, and let me here start with the CPIF. Excluding energy, the yellow line and the yellow dotted line. Here, as you can see here, actually CPIF excluding energy has dropped a bit and hovers a little bit above 1%. And then we think in our projection that this particular inflationary measure will pick up and move towards 2%. If you add energy prices but exclude interest rate payments, as you can see here, we expect CPI to move towards 2%, and will be very close to 2% towards the end of our horizon. But all in all, what this says is that we're coming from an environment with a lot of free resources, and that means that looking at it this way, the inflationary pressures are by no means exceptional. But this is, of course, provided also that we continue raising the rate according to our interest rate path. Now, if you look at CPI, the red line here, and given the way we calculate CPI, it shows up here very clearly that rising mortgage rates give high CPI inflation, and that will be with us for a while here. And also, in addition to this, given that the weights when it comes to calculating mortgages and mortgage rates also were changed at the beginning of the year, then sort of on the technical side, that made also CPI jump more than at least we expected. But all in all, this will be passing because eventually the policy rate also will reach its sort of normal level, and then those effects will kind of disappear from these time series. Because if you look at what happened in the middle of the 2000s, you can see that these two time series are fairly closely correlated. But at this particular juncture, and then what has happened is that on the one hand, CPI moved up, but on the other hand, CPI excluding CPIF excluding energy prices actually went down a bit, and that's quite unusual to have various indices moving apart the way it happened this time. But eventually, as time passes, they will come closer together. Now, what then matters in this environment is inflation expectations. And here we have also plotted what people answered about what they think about in inflation 1, 2, and 5 years out. And the answers we got in December and in March. And as you can see here, which is quite common when it comes to the 1 and 2 year horizon, inflationary expectations are going up. And that's basically because the short-run correlation between actual inflation and inflation expectations is high. On the other hand, which is a good thing if you look at the yellow dots there, you can see that with a 5 year horizon, inflation expectations are very stable. And that's, of course, something that is very, very good, the way we look at monetary policy in an inflation targeting environment. If those yellow dots over time were to start moving upwards, then of course we would be in a different environment. Let's say, for example, because the short run, if the short run inflation expectations were to sort of find their way into, let's say, wage negotiations and people's expectations on what's going on in the Swedish economy, then that would be a kind of a different matter. But we have no reason today to think that that's the way things are, because this is what it looks like as of now, and that's a pretty good thing in itself. And when this then is translated into a monetary policy, then this produces the conclusion that yesterday was the right time to increase the policy rate by 0.25 percentage point. And this process, as far as we can judge, will then continue for the foreseeable future until we reach a level where the policy rate is sort of roughly in line with what one would call a normal policy rate, given the demand conditions in the Swedish economy. Because also what I don't have on the slides here is that during this period the output gap measured in different ways will more or less be closed, and that means that in that kind of an environment the present policy rate is too low, given what we know about how inflation and other variables behave in the Swedish economy. But all in all, to summarize, the Swedish economy remains strong, and we have to adapt to that to ensure that over time we meet our inflation target. But at the same time, as far as we can judge, times will stay pretty good in the Swedish economy for the foreseeable future. Thank you. Questions, reflections on this?
The conference has been unmuted.
So, yeah.
Yeah, I think what I find the most peculiar about is your optimism about demand in general. Because as we saw your CPI, headline CPI number, the path was quite high. So what is your projection of real wages going forward? That is what I'd like to know approximately. It can't be much with that CPI headline. And obviously it's because mortgage rates are going up so much. And with the increase in mortgage rates, and I think we're looking at an increase in the vicinity of 50 billion kronor year on year right now. And that is almost on par with the increase in disposable income. So why do you really expect that demand will be so good going forward? That I find strange. Another thing, which is in the report, where you expect that real estate investments will continue to grow because you see that demand and supply conditions are favorable and that income conditions are good. With real wages the way they are, I have a hard time seeing that they are good. And when you look at demand and supply, the inventory sales ratio in the Swedish housing market has increased for 2.5 years now, and it has actually accelerated, which indicates that supply and demand conditions are actually deteriorating. So please, some reflections on this.
When it comes to the wage increases, what we do in this report is to assume that wage increases will be sort of traditional in the sense that for the past 10, 15 years, wage increases have been very modest, and over time that has produced a good increase in real wages over time. And what we know as of today, we have no reason to come up with another projection, just assuming that things will be roughly back to normal, and wage increases will be sort of within a range that the economy as a whole can handle. There are no signs as of today that something very different would happen. And then, given that compared to many other economies that we don't have a problem with government debt, we will continue to run a current account surplus, and consumption will sort of stay fairly stable. We don't expect consumption to vary a lot, and investments are still also on the high side. All in all, then that produces an aggregate demand situation such that this is in our judgment where we end up. When it comes to the housing market, it's of course hard to judge, but on the one hand, what you talk about is what one would expect when things normalize, in the sense that we're coming from a situation with an extremely low policy rate, and also for various reasons, not only domestic reasons, but also what has been going on in the global financial markets, low rates generally. When then rates start going up, one wouldn't expect that wouldn't show up at all when you look at the numbers. While on the other hand, so you would have a demand effect there. While on the other hand, we also know that the supply of new housing has been very low for many years to come, and over the past, and for the years to come. I mean, eventually that situation needs to change, because the major cities in this country are growing, and they are growing more and more, and that means that the housing stock has to be replenished one way or the other. Of course, what the net result will be, hard to tell, but eventually we need to build more houses in this country too.
Yes, if I just can, I mean, regarding wages, I don't think that, I mean, first of all, you can look at it in terms of nominal wages, and if you plot the nominal wage projection that we present here vis-à-vis, say, an output cap or something like that, you will find that it looks like a normal pickup in wages that you usually would expect given the business cycle development. And I think that as regards to CPI, it's a special aspect, because, I mean, in terms of that, you would say that in 2009, real wage development were really tremendously good, because CPI was negative, and at the same time we had fairly good nominal wage growth. So I think that's a factor that has to be brought into the equation when you look at the real wage developments just in terms of the CPI now ahead, because in terms of that, it's true that that would seem to be low real wage developments. But I think that knowing that given the high variability in the policy rate, that feeds back onto the variability of the CPI, that's a special factor that has to be brought into the equation. And as I said, nominal wage developments don't look very strange.
But real wages will be negative in the next 12 months according to your projections?
If you deflate them by the CPI, as I explained, that's a...
And it's reasonable that you do that because people actually pay mortgage rates and petrol.
Well, from our perspective, you know, it's the wage path that we believe would be consistent given other things with the inflation target and the way we presented the policy rate projection. That's the way we look at it. And as I said, I mean, our view is that the CPI effects are temporary. They will eventually go out of the system, and it depends. I mean, you can deflate it by the CPIF, then the picture looks a bit differently. I mean, we didn't have the discussion of bringing down the nominal wages in 2009 because the CPI was negative, and I think you should have some symmetry in the way you're reasoning here. When it comes to the demand developments, I mean, I don't think that the forecast that we present here is very strange in the sense that it looks quite similar when you look at the National Institute or at the Ministry of Finance, presumably because we look at basically the same indicators. And if you use these indicators to sort of project, you know, the path ahead, I think this is basically what comes out of such an exercise. That's not to say that there aren't any risks. I mean, that's clear. I agree with you that...
What's interesting is that you actually expect that declining savings ratio will compensate for the shortfall real wages, if you will. And I wonder, why should we expect that the savings rate should go down when interest rates go up so sharply?
Well, I mean, there has been a secular increase in the private interest rate, if that's what you're talking about. And it has been difficult, you know, to explain historically. We believe that there's room there for households to decline the savings rate at this point, and that can be used to increase consumption.
Because historically, when the GDP growth rate declines, we often see savings ratio go up.
That might be the case, but...
And now we're actually seeing interest rates go up, GDP growth go down, but savings will go down as well and compensate for the real wages. And that is something that something doesn't add up here to me, but that's just me.
Well, I don't know compensate for real wages. It's just a view that the savings rate is quite high, and we see scope for that to decline in the future.
But I mean, one wouldn't really expect to sort of real wages to sort of, that you would have sort of an increase, let's say, in real wages month by month or anything like that. I mean, here things happen in the economy, things move up and down. What really matters is in sort of an increase in the real wage over time.
Yes, about inflation expectations, you did precondition the repo decision today, the repo rate path today on inflation expectations or long-term inflation expectations not moving higher from here or considerably higher. But given the fact that you have raised the CPI path here, and that is actually what you question people about when you ask them about inflation expectation going forward, don't you see any risk here that inflation expectations actually will touch perhaps the same levels as back in 2008? And could you say anything about where you believe this limit is that is problematic here?
No, there are always risks, but I wouldn't put a number on those expectations, because as always, that depends on what's going on in the rest of the world and in the economy when that day happens. So there's nothing sort of mechanical about it saying that if, let's say, inflation expectations go up by X, then you would move the interest rate path by Y, because that's not. The world is more complicated than that, so we'll see.
There seems to be a fairly stable relationship over time between actual CPI outcome and the level of inflation expectations. I think that's, there clearly expectations are adaptive rather than rational, and in that sense, wouldn't you expect, given your own CPI path going forward, that you will actually see 5-year inflation expectations?
Well, we'll see. Yeah, we'll see. Time will tell. What we would expect is the one-year inflation expectations to go up, because they are highly correlated with actual CPI, regardless of the direction of the CPI. So we'll see.
I think, the responsiveness of short-term expectations 1 and 2 years ahead is much bigger than of 5 years expectations. And it's probably, I mean, they, as you saw from the picture, they've been sort of lagging behind a little bit, the CPI, and are now increasing. But you're probably right that given the forecast of CPI, there's some responsiveness of the 5-year expectations to be expected, maybe that they increased by a couple of tenths or so as of today. But I mean, it all depends on how much. And if they increase too much, that would signal, I think, some sort of confidence problems in terms of our job, whether we can keep inflation on track or not. But I agree with you that a couple of tenths would be a normal historical reaction, I think.
Yep.
In your CPI forecast, I appreciate that you raised it today, and the higher mortgage rates are one important factor behind the CPI raise. Could you elaborate a little bit on what kind of spreads you assume going forward? And I'm thinking there between the spread between the repo rate and the mortgage rates. They have been more elevated recently, and the interesting thing going forward here is that do you expect them to be elevated on the present levels, or do you think they will take another path?
It's of course hard to tell. We expect them to be higher than in the past, and time will tell, of course, where we will end up, but definitely higher than the historic average, and particularly higher in, let's say, 06, 07, because then the rates were very, very low. Then the issue which is difficult to judge is, of course, then, okay, then at the present level, or maybe a little bit lower, for how long, and how will this thing sort of evolve over time, but definitely higher than in the past. And, because in our judgment they were too low earlier, and then given what's going on in the rest of the world and here, rates will, it's likely that rates will, the interest rate margin will be higher than in the past, because it's not only, the only issue is not to what extent you sort of borrow in Swedish kronor. It also matters what the rates are abroad, and what also matters is the perception of risk in the system as a whole. And if the risk level gradually goes up over time, that also speaks in favor of sort of higher spreads than we had a few years back.
I have a follow-up on this inflation expectation and your view on the wage rounds. Now there is a risk that inflation expectation could rise here for various reasons. But what would trigger you to alter your monetary policy stance? Would it be enough to have the inflation expectation figures coming up, say this is summer? Or do you have to wait actually for the result of the wage negotiation in September, October, and then see if the results after the negotiations are too high or not before you react on monetary policy? Or do you want to...
That you can't say ex ante. It depends on what's going on in the rest of the world and in the Swedish economy when it's time to decide, because as always all these things matter one way or the other, but the name of the game is sort of to figure out how to add them up. And at least as far as I can judge, having now done this for a number of years, it's rare to say that everything hinges on one single number and sort of strategy comes out of that. It doesn't really work that way, because there are always all sorts of things going on here and in other parts of the world, and there are also sometimes actually unknowns that were not on the horizon until they sort of show up fairly late, so to speak, when you have to decide. So to stipulate kind of ex ante many months in advance that if the following thing happened, then we would do this, that, or the other. That's not how real decision making works.
You can have an impact on if wage negotiation would be too high, then we would react in that way to actually dampen the wage expectation if you see them out.
Well, one can have all sorts of views on this, but then one would need to sort of better understand that day what the output gap looks in the economy, what inflation expectations are, what the actual inflation happens to be, what view we take on productivity. And other factors like that, and it's sort of when you put these things together, you come up with a conclusion.
A trivial comment ex ante would be that if you look at our wage forecast that is roughly around 3.5% on average or so over the forecast horizon, that would be, an ex-ante indicator of what, given that everything else develops as we expect, would be kind of in line with the sort of inflation expectation that we assume and the policy rate increase that we assume. So that's an ex-ante indicator of roughly where we should be.
More questions?
A follow-up on that, and on the labor market, there seems to be a bit of matching problems that it's hard to match between supply and demand. And it's pretty early in the cycle. How do you see that phenomenon or problem?
Well, I mean that's one issue before us, because if you look at where we are in the cycle, and if you look at what these things have looked look like in the past, and when labor shortages have started showing up in various sectors of the economy, then I mean we'll have to go through that debate at this juncture in this cycle, pretty much in the same way as we have had to do it in the past, when we have been in a sort of a similar position, because that's what one would expect, given that we are where we are. And then of course that then brings the whole debate to the fore about how the labor market functions and what it takes to move people between different sectors in the economy. So I'm feel quite confident that we'll have a debate about labor market issues for a couple of years to come. Yeah.
I must say that this focus on wages and the labour market to me seems almost a bit misplaced. It seems as if we're in the 90s here, because the wage sum in the Swedish economy is around 1,300 billion kronor. The debt stock of households is 2,500 billion kronor. That means that 1 percentage point increase in wages corresponds to 50 basis points increase in the rate. I mean, the potency of interest rate is so much greater than the potency of wages, especially after taxes. So if we focus on will wages come up 1 percentage point higher or not, as if that's the big deal. I mean, interest rates are so much more important. And mortgage spreads have come out 100 basis points.
Well, both yes and no, because every wage earner does not have a mortgage, and what the net effect of these things is within the household sector. That's a sort of a non-trivial exercise to come to a conclusion on that one. So a simpler answer is to say that both matter.
And one matters more than the others?
Well, it depends on what happens, as always. These are the projections that we do, and this is our best judgment as of now.
It has changed over the past years. That must be acknowledged. That
well, what has happened over the past years, or not only the past years, but during quite a period of time, is of course given the fact that the households are borrowing more, and given that more households than in the past are borrowing using a variable rate. The interest rate sensitivity is likely to be higher today than, let's say, 10 years ago or 15 years ago, because back then we had a completely different system. But that's not saying that wage developments don't matter. They matter for sure. But here, and what we're doing, this report is a sort of a very kind of traditional view on wage developments, because we really don't have good reasons to come up with any other view where we are right now.
You said that commodities will stay high. And, is it primary inflation problem, or at what stage does it become a growth problem? What's the trade-off between?
That probably will vary quite a lot from country to country. Of course, the whole world can compensate for trying to compensate for higher commodity prices. So in that sense, if everybody is trying to sort of do that, then we end up with global inflation one way or the other. So really the issue is how to, in a good scenario, to have this evolve in such a way that these increased commodity prices translate themselves into changes in in real prices, but not without so much compensation going on, so that globally it leads to global inflation, because inflationary expectations take hold, and that's not counteracted by central banks. But it's incredibly hard to judge sort of what the balance will be here, and it will differ quite a lot, I think, from country to country. Because take ourselves, if you live in an economy where you produce quite a lot of high value added good, then the sort of raw, so to speak, commodity price content isn't always that high, because much more of it is just value added. While in other types of economy, basically good chunk of it is commodity prices as is, and in that environment, of course, it's incredibly much harder to deal with these issues.
I think also maybe, I mean, until recently, I think that sort of the main analysis is that these rising commodity prices have come as part of a global demand increase, which is quite maybe a different situation that we've seen quite recently, where they probably more come from political unrest and via the supply side. And that, I think, would warrant different kind of perspective in terms of, what they do to the economy. But it's clear that, I mean, inflation pressures are rising, and you can see concerns about these effects getting second-round effects on more underlying inflation rates. And that's a debate that we will have for some time ahead, I think.
Of course, the supply-driven could actually at some stage threaten world growth.
Could, yes. Yes, so that's more worrying than if it comes via increasing demand, of course.
Okay, yeah.
The real repo rate.
Sorry.
Okay, could I just ask about the real repo rate? There's chart 9, I think it is, where you have the real repo rate. Comparing the April and February forecasts, it only shows very minor changes, and that is, of course, because the forecast for CPIF is only marginally changed. But why is the rationale for looking at that rather than the CPI-based real repo rate? Because that one has changed considerably. It's shifted down by 70 basis points for 2011 and 12, I think. Can you give some comments on this fact? And
No.
why you...
Yeah, no, I think we should probably, review this figure. I mean, this is based on a particular definition of how the real rate is computed, and it's given in the note how exactly it is defined. But I mean, this may create some misleading aspects of it. I mean, for example, this one, although being based on the CPIF, it doesn't capture the drop in the CPIF, because it's smoothed out by a 4-quarter, I think, moving average or so. And you could ask these relevant questions that you're asking in terms of the CPI. So I don't think the picture is adding much to I would say, over a year or so. I mean, the only thing that it says is that the real effects measured like this are small. But it's not adding much, and I agree with you. Maybe it's generating more questions than it's answering.
Now there was a question from somebody listening in. Please go ahead.
Oh, hello, Thomas from Morgan Stanley. I just have a question. So, to sum up all this discussion, the bottom line is that we can assume that the current repo rate path is consistent with your current new CPI inflation. And if this is the case, what would have to happen that the repo rate path would be revised one way or the other at the next meeting? And if you could tell me, what do you think are the risks to any revision up or down? What I basically mean is that at the last meeting you were indicating that if commodity prices go up, then the currency doesn't strengthen anymore that much. This will imply that the rate path should go up. And this has been repeated in various press releases over the period. So I just wonder, where are we standing right now with this higher inflation forecast that we have today compared to the path, if it's possible?
Okay, when it comes to the inflation forecast, and given that the CPIF and the CPI sort of have moved in different directions. That's quite unusual, and one can say a peculiarity at this particular juncture. When it comes to the rest of the projections and the rest of the numbers, they have come in sort of roughly in line with what we talked about in February. So the conclusion this time was that simply there hasn't happened enough in the economy as far as we can judge in order to sort of change our view. But on the other hand, if for various reasons inflation ends up being higher than what we have expected, being that what's going on in the domestic economy or what's going on in the rest of the world, clearly over time that would move the interest rate path. While on the other hand, just for the sake of the argument, if something really happened, let's say, within Europe in such a way that it's not only southern Europe that is severely affected in growth terms when it comes to what's going on dealing with the fiscal issues, so that would spread further north, then of course we wouldn't go unscathed out of an event of that type. And then if that were to happen, then we would need to sort of reflect on that, and things would move in the other direction. But this particular time, which is I think actually quite unusual, not all that much happened between February and now, and in most all other instances there has always been surprises of different types that we have had to include in our reflections. Per, do you have anything to add?
Just maybe to add that I guess in practice things are a bit more complicated than in a simulation that we gave last time, and it's not only, as Stefan explained, the energy prices that have been rising since last time, and we have this sort of complicated picture in terms of the CPIF and the CPI, and we've tried to explain as well as we could how we saw that in terms of a policy challenge. So it's not only an energy price increase that you should look for when you try to understand why we didn't revise the policy path this time.
Yes, I had a reflection on that. You said nothing had happened since last time, but there's actually quite a lot happened since last time. We've seen the ECB react on higher inflation abroad. That must be a change. That wasn't in the cards the last time.
Okay, let me rephrase, not enough has happened. I'm not saying that time has completely stood still. And
it's quite a big change.
Well, yeah, but when...
And that has no bearing on Riksbank?
But when it comes to our projections include assumptions about interest rates in other parts of the world, and this particular move actually, from that perspective, went with our view of the world in the right direction, and that's also then one factor that plays a role here.
Maybe it also depends on where you are in the system. If you're the governor, you might have that impression. If you're working with the forecast, you might have a different impression. I mean, most numbers have actually changed, including the foreign interest rate assumption. So, but at the end of the day, maybe the things that stand out are the inflation picture, the effects in the inflation picture.
Yeah, I mean, I agree with Per, but it wasn't that it was enough to come up with a sort of a completely different view. And I mean, you and others have followed this long enough to also be aware of the fact that eventually things happen, and we come up with new projections, and then we have to sort of reflect on that. But as always, this is our best projection this time.
So may I have one more question then? So what's then enough? I mean, oil at 150, 60 would be enough, and also how much would the inflation expectations have to rise that you would start thinking to go upwards with the rate path? I mean, I understand that you're focusing on the 5-year right now, which is obvious, but if they would go to 3%, would that be enough? Just to quantify a bit, because...
But I have argued already that I'm not ready to do those kind of quantifications, because just to pick one number out of many, then that just won't work, because eventually when things are decided, you have to look at all the numbers and all the various projections in order to add things things up. It's an oversimplification to say that if just one single number moves by X, then it's obvious that this, that, or the other should happen in a particular way. We just have to wait and see and get back to that issue when we come to the next decision-making juncture.
Thank you. And the last question, from a bit different story. I mean, about the housing market, we have this report on the 5th. And can we just assume that the bank will not put as much of a focus on the house prices as it was arguing before? That's my first question. And the second question refers to the STIBOR Tomex rate recently. I don't know if you have more of an insight than we do, but the fixing just started to be very volatile. So I wonder if you could comment on this as well. Thank you.
Okay, first when it comes to the book that we put out quite recently, it wasn't done with the sort of saying that we do all the chapters here arguing back and forth because this is supposed to be sort of very precise background, so to speak, when it comes to monetary policy. What we wanted to do there was to put the searchlight on various aspects of the housing market and how one can look at the housing market. And it's not that there is a sort of a one-to-one relationship to what various people say in that book and to monetary policy. It has increased our understanding of what is going on, but it continues to be an issue. Not an issue in the sense that we have a target for house prices or anything, but if borrowing continues in the household sector, and if it continues for many years to come, then leverage in the household sector will continue to go up. And that means that the risk in the system as a whole goes up, and that's something which is very worthwhile keeping a close eye on. Our hope is, given the loan-to-value ratio that was put in place by the FSA and the interest rate increases that we have made, and given that we publish an interest rate path telling its story that the policy rate will go up, that this will put us over time here gradually in a better position, so that we don't have to worry about it as much as we had in the past. But given the level of debt in the household sector, it's at least in my view, for sure, is an issue which won't go away for many years to come. And then when it comes to STIBOR, yes, STIBOR has been more volatile than in the past. It has taken a while when we ended our various loans and when the excess liquidity in the system as a whole came to an end, to have various market participants adjust to that, and it has taken a bit of time. It may be that we are moving into a world also where one can't really expect that everything is 100% as stable as it was before things started falling apart in 2007 and 2008. We'll just have to wait and see.
Thank you very much.
Okay, if there aren't any more questions to those of you who have been listening in or watching in various parts of the world, and those who came to see us here in the room, thank you for many good questions. Thank you for a good conversation about Swedish monetary policy, and happy Easter to you all. Thanks.